So, think about the last time you went to the movies. You buy a ticket, you hand over your money, you sit in a dark room for 2 hours, the credits roll, and you leave.
Right. It's a completely finite relationship. The studio captures your $20 once, and that's basically it.
Yeah, exactly. And then they have to spend like hundreds of millions of dollars on production and marketing just to beg you to come back for a sequel 3 years later.
It's a brutal cycle, a high-risk engine of constant customer reacquisition.
But if you look at the landscape of modern digital entertainment, you find a completely different model, a model where the creators don't just want you to visit for a weekend. I mean, they want you to move in, build a house, and hang out with your friends in their ecosystem for the next 20 years.
Which fundamentally changes the economics.
Totally. Welcome to this deep dive on the Japan Stock Podcast. Today, we're unpacking the mechanics behind one of the most misunderstood entities on the Tokyo Stock Exchange. We are talking about NEXON.
Right, NEXON.
Our mission today is to figure out how a company that's routinely miscategorized as just a simple video game developer managed to post record revenues of 475.1 billion yen in 2025.
Unbelievable numbers.
Yeah, and they amassed this staggering cash fortress of over 800 billion yen.
And that cash position is genuinely remarkable when you place it against the broader macroeconomic context right now.
Oh, for sure. I mean, look at the broader tech and media sectors lately. It's just been massive layoffs, right? Aggressive cost cutting everywhere you look.
Exactly. The unit economics across the industry are rapidly deteriorating. Yet, we are looking at an entity generating unprecedented free cash flow and actively expanding its return on equity in that exact same hostile environment.
So to really understand their financials, we have to start by tearing down the misconceptions about what they actually sell.
We do. Because if you look at their revenue engine, the 80-20 rule is in full effect here.
Right. The vast majority of NEXON's massive profit is driven by just a few core franchises. We're talking Dungeon&Fighter, MapleStory, and the FC Sports franchise.
Yeah. But calling them a game company is missing the underlying business model entirely. It's a fundamental analytical error.
Wait, really? How so?
Well, if you model their future cash flows based on a traditional video game product cycle, where a game launches, sales spike, and then they inevitably decay over 12 to 18 months, your models will be completely wrong.
Because they don't operate video games.
Right. They manage virtual worlds.
Oh, okay. So think of a traditional AAA game studio as that movie theater we just talked about. NEXON, on the other hand, is building digital theme parks.
That's a perfect way to look at it.
They honestly do not care about the initial ticket price. They care that you walk through the gates, realize all your friends are already inside, and decide to stay for a decade.
Exactly. Because the switching costs for the consumer aren't financial anymore. They're deeply social and emotional.
Which has to alter the unit economics, right? That creates an incredibly wide economic moat.
It really does. If you compare NEXON's trajectory to a traditional, massive budget studio that might spend, say, $200 million on a single-player narrative game, the divergence is obvious.
Because the traditional studio relies on that one-off retail transaction.
Right. If their game flops, the studio faces existential risk. NEXON relies on continuous microtransactions from a deeply entrenched community, and that specific strategic DNA was forged through some intense industry friction.
You're talking about the post-COVID slump.
Yeah, that and Apple's implementation of the IDFA privacy changes.
Oh, wow. Yeah, that Apple privacy change was a massive tectonic shift for the industry.
It was a bloodbath.
For anyone unfamiliar, IDFA essentially allowed advertisers to track user behavior across different apps. When Apple allowed users to opt out, it blinded the mobile advertising industry overnight.
You could no longer serve hyper-targeted ads to acquire high-spending players, so the cost of user acquisition just skyrocketed.
Companies that relied on the traditional mobile playbook, constantly buying cheap new users to replace the ones churning out, they just saw their margins completely collapse.
But NEXON survived and ultimately thrived because the virtual world model is inherently insulated from user acquisition costs.
Because they already own the community.
Exactly. By prioritizing the retention of their existing player base over driving up short-term average revenue per user, or ARPU, they bypass that advertising bloodbath entirely.
But, Wall Street famously hates delayed gratification, right? The pressure from institutional investors to monetize a captive, loyal audience is immense.
Oh, absolutely. Management teams are constantly pressured to squeeze their users for a quarterly earnings beat.
So how did Nexon's leadership get away with leaving money on the table? I mean, how did they not trigger a shareholder revolt?
Well, it requires immense operational discipline. And their management has built a proven track record of shielding the community from short-term financial engineering.
Give me an example. What did that look like in practice?
A perfect operational example materialized around the 2022 and 2023 timeframe. Their flagship mobile title, Dungeon&Fighter Mobile, won the prestigious Game of the Year award in Korea.
Oh, nice. So naturally, the servers were probably flooded with a massive influx of new and returning players.
Exactly. Now, the traditional corporate playbook says you immediately launch a massive monetization event.
Right. You sell exclusive cosmetic items, you push aggressive microtransactions, and you just squeeze that spike in traffic for every yen it's worth.
But the live operations team did the exact opposite. They deliberately pulled back on scheduled item sales.
Wait, they pulled back?
Yeah. Instead, they handed out massive free rewards to the community to celebrate the win. They intentionally absorbed a short-term hit to their earnings per share.
Wow, so instead of milking the players, they gave out free stuff.
Exactly. Because in the context of a virtual world, breaking the trust of your community just to hit a quarterly revenue target is fatal to the ecosystem.
So by sacrificing that immediate cash grab, they dramatically increased the lifetime value of those player cohorts.
Yes. The loyalty generated by that restraint is exactly what flows directly into their expanding return on equity today.
And that discipline clearly set the foundation for the current numbers. I mean, fast forwarding to the immediate reality, 2025 was a record year, hitting that 475.1 billion yen revenue mark.
And Q1 2026 just broke quarterly records again.
Firing on all cylinders. So what's the actual causal chain for this current growth phase under CEO Jung-Hoon Lee?
It's driven by a two-pronged strategy they call the IP Growth Initiative. This framework divides capital allocation into vertical and horizontal growth, and the recent data shows both levers are firing simultaneously.
Okay, let's break that down. What's vertical growth looking like right now?
On the vertical side, you have MapleStory, idle RPG performing exceptionally well in Asian markets.
Got it. Going back to our theme park analogy, vertical growth is like adding a brand new, hyper-localized, record-breaking roller coaster to an existing park.
That's exactly it.
You already own the land, you have thousands of daily visitors. You just want to give the locals a reason to upgrade their season pass and spend more time inside.
Right. You're expanding established properties like Dungeon&Fighter or MapleStory into new formats. It leverages their established IP, resulting in a very high probability of success and virtually zero customer acquisition costs.
Okay, so that's vertical. What about horizontal growth? That sounds a bit riskier.
It is. It requires an entirely different risk profile. It involves taking the massive cash flow generated from the existing Asian parks, allocating it across the world, and building a structurally distinct theme park in Europe.
To attract a totally different demographic.
Exactly, which is literally what they executed.
Yeah.
They allocated massive capital to Embark Studios in Sweden to build ARC raiders specifically for the Western market.
Oh, wow. So taking a huge swing globally.
It was a high-conviction bet on creating a brand new structural pillar for the company, entirely independent of their legacy Asian franchises.
And it worked, right? The October 2025 launch proved the viability of that horizontal strategy, diversifying their revenue base geographically.
It did. It was a massive global success.
But you can't successfully launch a global title like ARC Raiders without massive upfront capital.
No, you can't.
And that requires us to look at where Nexon is pulling this cash from, which leads directly to the unprecedented financial maneuver their Korean subsidiary made in June 2026.
The repatriation.
Yes. NEXON Korea Corporation wired a massive dividend of surplus. 373.4 billion yen, to be exact, straight back to the Japan headquarters.
Repatriating that level of cash is a highly strategic move, especially when viewed through the lens of recent Tokyo Stock Exchange corporate governance reform.
Right, because the TSE has been heavily pressuring Japanese-listed companies lately.
Exactly. Pressuring them to improve their price-to-book ratios, optimize their balance sheets, and return excess cash to shareholders rather than just hoarding it.
So what does a 373 billion yen internal wire transfer mean for you, the retail investor holding the stock?
It means management is actually listening to those governance mandates.
Yeah, they didn't just sit on that repatriated cash. The direct result of moving those funds to Japan was the August 2026 special dividend announcement.
A massive announcement.
They tripled the expected dividend from 15 yen to 45 yen, and that is on top of an aggressive, fully completed 100 billion yen share buyback program.
Which completely reframes the investment thesis from a pure growth narrative to a highly disciplined capital allocation machine.
By funneling the cash generated from their virtual worlds into aggressive buybacks and special dividends.
Right. They have built an absolute financial fortress. They are protecting the stock price against macro volatility while simultaneously rewarding long-term shareholders.
It's incredible. But, a fortress is only as strong as its walls, and Nexon's walls are exposed to some serious external forces.
Always. There is no such thing as a risk-free global operation.
Exactly. The cash might be flowing back to Tokyo, but the actual virtual parks are deeply embedded overseas. I mean, you can't generate 373 billion yen in Korea or massive compounding revenue in China without exposing yourself to intense global friction.
The geographic risk profile, particularly regarding the Chinese market, requires heavy scrutiny right now.
Yeah, let's talk about China. Historically, their partnership with Tencent to publish Dungeon&Fighter in China has been a primary engine of their profitability.
It has. But the recent data proves it is a notoriously volatile engine.
Definitely. Looking at the recent timeline, in Q1 2026, they executed a major New Year update for the PC version of DNF in China.
And it was a massive success, driving huge year-over-year growth.
Right. But then rolling into the Q2 2026 data, the monetization severely lagged. Player engagement remained relatively stable, but the cash just wasn't following.
This forces us to differentiate between macroeconomic headwinds and operational missteps.
Right, is the Chinese consumer pulling back because of broader economic anxiety, or did Nexon fumble the execution of the game updates?
Did players just tighten their wallets, or did they stop spending because the new roller coaster wasn't thrilling enough to justify buying the VIP pass?
Exactly. So what do the numbers say?
Based on the live operations data, this was primarily an execution and content issue on Nexon's end.
Oh, really? How so?
The mechanics of the failure are quite clear when you look at the updates they rolled out in April and over the summer. They introduced new raid tiers, but the in-game rewards didn't justify the real-world cost or the time investment required from the player base.
Ah, I see. In a virtual economy, the return on investment for the player's time is everything.
Everything.
If I have to spend 40 hours grinding a new raid or pay $50 for a shortcut, the virtual sword I get at the end better be a massive upgrade. If it isn't, I close my wallet overnight.
That is the fragile nature of the virtual world model. If the content feels stale or the reward loop breaks, monetization plummets immediately, even if players are still logging in to chat with their guild.
Wow, so how are they fixing it?
Well, the live operations teams are furiously hyper-localizing new content. They are banking heavily on a major September National Day update.
Okay, so September is the big test.
Yes, they're introducing entirely new raid mechanics to recalibrate the time-to-reward ratio and stabilize the Chinese revenue heading into Q3. It's a critical execution test for management.
China is clearly a high-reward, high-maintenance relationship.
Without a doubt.
And to offset that reliance on the Asian market, they executed the horizontal strategy we discussed earlier, launching Era C raiders globally and massively expanding their footprint in North America and Europe.
But establishing a deep presence in the U.S. introduces a whole new set of geopolitical anxieties.
Yeah, we have to talk about the Trump effect, shifting trade protectionism, and the threat of sweeping cross-border tariffs.
The threat of tariffs is arguably the defining macroeconomic anxiety of the current market. I mean, industrial, hardware, and consumer goods companies are scrambling to model the impact of aggressive supply chain disruptions and freight costs.
But this is where Nexon's underlying product structure provides a fascinating advantage.
It really does.
Because their product is literally millions of lines of code moving across international borders at the speed of light via fiber optic cables. So they naturally bypass physical supply chain tariffs.
You cannot put a shipping tax on a digital cosmetic item.
Exactly. I mean, whether you agree with the policies or not, the market has to react to tariffs, and Nexon is basically tariff-proof.
The digital nature of the asset class fundamentally alters their risk profile compared to a traditional manufacturer. They don't worry about port strikes or container shipping rates.
Right. But it would be a mistake to say they face no headwinds in the U.S. market.
True. The friction they encounter is regulatory, not physical.
Right. Like what?
Expanding in the West exposes them to evolving data privacy laws. intense scrutiny over loot box mechanics, and the persistent threat of consumer litigation regarding digital purchases.
And we also have to factor in the complexities of global finance. I mean, if you are a Japanese-listed company generating the vast bulk of your revenue in Korean won, Chinese yuan, and U.S. dollars, the foreign exchange markets are a massive battleground.
Oh, the FX factor is a strict financial reality that dictates their reported profitability.
Let's quantify that leverage. Based on their Q3 2026 projections, every single 1 yen move against the US dollar impacts their revenue by approximately 778 million yen.
And it alters their operating profit by 191 million yen.
Wait, 778 million just from a 1 yen shift?
Exactly. It's massive leverage.
So let's translate what that massive leverage actually means for your portfolio strategy. If the yen weakens against the dollar, your domestic Japanese stocks might suffer from rising physical import costs for energy and materials.
Right, they get squeezed.
But Nexon, sitting on a global digital product, is suddenly converting massive stacks of US dollars from ARC raiders into far more yen on their balance sheet.
That 800 billion yen cash fortress is highly diversified across multiple major currencies. Because they operate globally without the anchor of physical supply chains, their revenue streams act in direct opposition to traditional domestic equities.
So if you're a retail investor looking at a volatile global market, Nexon acts as a unique, high-yield currency and macro hedge.
It really does.
You're gaining exposure to a globally diversified revenue stream, won, yuan, dollars, euros, all wrapped up in a Japanese equity that pays a 45 yen special dividend and actively buys back its own stock to support the share price.
Synthesizing all these operational and financial threads really reveals why the broader market consistently misprices this asset.
Because they just look at the surface.
Analysts insist on evaluating Nexon as a hit-driven video game studio, projecting boom and bust cycles typical of retail software.
When in reality, they are a compounding virtual world operator. They are managing digital real estate that retains citizens for decades.
They have weaponized the social switching costs of their communities to create a cash-generating engine with aggressive, shareholder-friendly capital return policies.
Furthermore, they possess the operational discipline to absorb a short-term EPS hit if it preserves the integrity and lifetime value of those digital ecosystems.
The 373 billion yen repatriation from Korea and the subsequent tripling of the dividend are simply the mechanical proofs that the virtual world strategy works at scale.
Which leaves us with a lingering structural question to chew on today.
What's that?
Well, if Nexon's relentless prioritization of decade-long player retention and digital ecosystem management is currently generating 800 billion yen in cold hard cash, what does that mean for the rest of the entertainment industry?
It deeply challenges the financial viability of traditional digital entertainment models.
Exactly. Like, are the traditional massive budget single-player gaming studios that rely on selling you that one-off movie ticket destined to collapse under their own weight?
It's a real possibility.
Are we watching the death of the video game as a standalone product and the birth of infinite, self-sustaining digital economies? It's something to think about the next time you evaluate where your portfolio is allocated.
For sure.
Thank you for joining us for this deep dive into the digital economy on the Japan Stock Podcast. Keep questioning the surface narratives of the stocks you follow, and I'll see you next time.